I wanted to tackle a subject that I think is going to become more and more relevant, important, critical for all of us to understand, and especially if you follow the one rental at a time kind of journey or story. And that is lots of the talking heads on TV are talking about record low inventory. And just to be clear, what are they talking about? They are looking at the entire US map and they're saying that the available inventory, which means you've signed a listing agreement, is at a record low. This is meant to, I guess it's meant to scare you a little bit. It's probably meant to spark interest or demand. But as always, we are going to break it down on this channel. We're going to talk about where it's true, where it's not, and we're going to talk about how you can take advantage of it, because I do think there is a way for you to take advantage of it, especially with the one rental at a time mindset and story. But first, let's talk about the numbers, right? I just took some notes, read 3 or 4 different articles on it. And as far as number of available homes, for December now, which is the last month we have data for, the listings were down 12% year on year. That's that's a big number, right? Down 12% year on year. If you want numerical numbers, they're saying that's 155,000 less listings this December versus last December, which is pretty interesting because if you remember last December, we were kind of nervous, right? If you go back and look at the stock charts, we had a drop. You are what? I don't know what that is. Um, but again, we had a drop in available homes, which is down 155,000 listings. So another thing that is probably even more alarming to me is the rate of new listings. Again, December on December is down 11.2%. So again, these are some pretty large numbers that are going on. And I just turned off my printer because I think my wife was. Listings are down 155,000 and the new listings are down 11.2 thousand. Oh, I guess it came out. Anyways, it is what it is. Uh, the other thing that's interesting is prices. The prices are up roughly 3% to 2,900 and $299,950. And then lastly, the kind of metrics that we have for November is they're down to a days on market of 79 days, which are down, just making sure this printer's off. They're down 2 days from last year. So what does this all mean? So first, we need to break down what does it mean for available inventory. This thing is driving me crazy. We need to break it down for available inventory. If you watch my daily financial news, you will know that I talked about New York and specifically Manhattan today. And Manhattan saw a drop in prices of 7.5% again in December. It saw listings explode and it saw available inventory up to an 8-month supply. Kind of exact opposite of what's going on in the rest of the country. So if you're in the high priced markets, this thing is driving me crazy. So if you're in high price markets, you're going to see a rising inventory. So if your market, like the median for Fresno is 250 or 260, if you're in the 500 range, your market is going to see a ballooning of inventory, right? So anytime people talk about the market, that's the entire market of the US. So if you're in a high price market, I'm afraid I don't have good news for you. You're going to see price drops. You're going to see inventory explode. And I think you're going to be in trouble. However, the majority of us play at the affordable home level, right? So the affordable home market, which in Fresno, right, if the median is 260, affordable homes are below 200, that inventory is hard to come by, especially inventory of quality and of good condition. There's just less of them. So why is that? Well, I think there's a couple of things going on that we need to appreciate, and then we can talk about how to take advantage of them. First off, whether we like it or not, During the crash, meaning from like '08 to kind of like 14, lots and lots of hedge funds and deep pocket investors came in and bought thousands and tens of thousands of foreclosures. And they bought these foreclosures because they wanted to be rentals. We had always anticipated that these organizations at some point would be sellers, right? That's what we told ourselves. Hey, when the prices go up, these hedge funds will sell them and inventory will get back to normal and everything's good. But that's not happening. What's happened is they've realized being a landlord at such a low basis, pretty good business. So they've created funds, they're taking them public, and they're getting their equity back other ways. So where we thought we were going to have sellers of tens of thousands of units, they're holding on, right? They're not selling. The other thing is, quote unquote, baby boomers who used to be the move up buyers, they're also not moving, right? Average stays in home used to be 5 to 7 years. Now it's approaching 11 to 13 years. So this move up buyer trend that we used to have is not happening. So all of this is to say there's just not as much listings coming on at that below 200 level again for my market that we expected. And then what also is happening is all the new development, all the builders, at least in my market, they'll be building above the median. So that just leaves a huge gap in the market. So that's what's happening. So again, it's not surprising that listings are down because a lot of the forced sellers we thought would be, or the hedge funds are not, baby boomers are not selling. And again, that market below the median, they're just not building anything. So there's just not a lot of first time home buyer stuff on the market today. So how can you take advantage of this? Well, the good news is if you come in and you buy affordable rental properties and you manage them well and you're conservative, you put 30% down or whatever is required, you're very likely to have good appreciation, right? You're going to have disproportionate appreciation because the new housing stock's being built up here. They don't build any more down here. So you're going to get a natural pull as inventory continues to shrink. So I know a lot of the properties we bought during the crash, we've enjoyed great appreciation and we have no intentions of selling because housing is going to go up. I think multifamily is overpriced. I've done lots and lots of videos on those as of today, but housing still has more room to run. Low mortgage rates, great economy, rents are up. Rents are up again this year. It is a great time to be a landlord of single family homes. Again, single family homes bought below the median are probably some of the most riskless investments today. Again, conservatively financed, not in a war zone. Um, there's nothing there. So if you can get them and you can buy them, it's a great time. So yes, I think you can prosper in this environment. You just have to be a little bit aggressive. You have to hold on. And hopefully at some point, like we talked about in our book, One Rental at a Time, you'll be able to 1031 exchange into other assets like we did to multifamily. Because I think multifamily is overpriced today. But in 5 years, when all of these syndications go boom and people have to sell because their term is up and they can't refi, maybe you can 1031 out of houses into apartments. I know that's what we're looking to do. So we're going to keep our houses and then maybe do another 1031 exchange in 2023, 24, maybe 25. But if not, we'll keep the houses because they cash flow. There's good appreciation. And I think today's a great time to be a landlord for single family homes. I know there's lots of people that talk about bigger is better. I just tell you to do the math. And if you're just a mom and pop investor, there's nothing wrong with single family homes in today's market. All right, well, that's my thoughts. You have a wonderful day. Sorry about the little noise with the printer. I guess I have to communicate with the wife better when I'm doing something live. Have a great day. Take care. Bye.